Hello everyone, I am Sidhant. Today we will discuss the second chapter of the accounting and the finance for the bankers. And the chapter name is calculation of the yield to maturity. As I already said you that the module A of the accounts and the finance for the bankers is very important as far as numericals are concerned. Reason being, lots of numericals are asked from this section only. What you need is practice as much as you could. I will discuss all kind of possibilities of asking the problems. I will just give you the basics. What you need is to develop an empire from that basic. In this chapter also, I will divide the chapter between the theoretical part and the numerical part, as this chapter is also as important as numerical part because theory is also asked from this chapter. So we will begin our discussion with the yield to maturity. What is yield to maturity? Why there is a need of studying yield to maturity in the banking scenario, or to any customer, why they need to know what is YTM. With an example, I would request everyone to bring a pen or paper when you watch these videos, as it will help you. So in the last chapter we have discussed that in any year or so, before YTM we should first understand what are bonds and debentures, because this YTM is applied on the bonds. The bonds are nothing, it's just a source of raising money from the public. Let's say there are two ways to raise money. Is equity, which is nothing but have an ownership in the company, and they will take the money from you and they will give some amount of ownership to you. And the second one is debt. Debt are charged at the rate of interest, and in this debt there are lots of provisions are there. One of them is the bank loan, and another one is bond, okay, and also debentures. The only difference between bond and debenture is the use of the term in the countries. The bonds are used in Britain and debentures are used in United States. Or you can also distinguish on the basis that these bonds terms are used by the government agencies in India and debentures are by the private companies. So we are discussing bond. What is bond? It's just one of the ways to raise money. So how this works, how this bond works. Let's say the bank or any company had issued a bond of rupees 10,000 of rupees, and they are giving some amount of rate in this bond, let's say 10%. Okay, this 10% you will earn every year, and at the end or at the maturity you will get the whole amount. Unlike fixed deposit, what you have in the fixed deposit, you deposited the money and you will get the interest plus the total amount at the maturity time. But in the bond, what is the provision is that in the year 1 you will get this 10% of interest, or you can say 1,000 rupees. Then year 2 you will gain another 1,000 rupees. Let's say it's the maturity up to 5 years. Then year 5 you will get that 10,000 plus 1,000. This 1,000 is the coupon rate. This rate is nothing but I call it a coupon rate in the terms when we discuss about the bond. This is coupon rate. So this all money you will get from if you subscribe the bonds. So this is how the bond works. Now the question arises, since we have understood what is bond. Now we will discuss what is YTM, ill to maturity, because that is a mechanism which is applied in the bond to know whether this provisions is profitable or not. Since the bank A is taking 10,000 of rupees, and what they are giving this much amount to the public, whether it's profitable or not. How can a customer knows that? In India there is very less financial inclusion, so the people doesn't know on which and why they are investing the amount. But if they are a very financial sound customer, so before let's say it's you who is very financial sound customer, you will first inquire about this bond is profitable or not. Then only you will deposit this 10,000 of rupees, or you will subscribe the bond. How you could know that it's profitable or not? It could be known through the YTM, which is called a yield to maturity value. In this, what is done? You will calculate this amount, and you will find the present value of all these amounts, and if total collectively, if the present value of all the whole amount collectively exceeds the amount you have deposited in the first year, if it's greater, then it's a profitable one, and if it's less, then it's not profitable one. All the values is greater than the deposited value, then only you are in profit according to by keeping the market scenario into concern. Now we will see some terms which is very important in this chapter, like the face value. In any bond is like this, a kind of certificate in which everything is mentioned. So there are some terms you will find when you see the bond. The terms are face value, the amount to which you have subscribed is face value. In the last example, the amount you deposited as a customer to the bank for taking the bond, not fixed deposit but the bond, then this is the face value. Next, the coupon rate. The coupon rate here, the coupon rate is the amount of rate you will get every year as an interest, is the coupon rate. There in the example we have seen 10% was the coupon rate. Here I would also like to mention there are two kind of rates applied. One, the rate of return, which is different, and coupon rate is the rate related to the coupon. The rate of return is nothing which is related to the which is quite related to the fixed deposit or recurring deposit interest. The way that interests are found, these interests are also found, and it depends on the market. But coupon rate is the rate associated with the bond itself. So the next term is maturity. The maturity is the total amount of period when the bond get matured is the maturity period. Next, the redemption. The redemption is nothing but the total scenario of taking or depositing the money or taking the money when it is get matured is redemption. In other words, the bonds are generally issued at discount and redeemed at par. What does it mean? Their par. It means if there is a bond of 10,000 of rupees, okay, and issued at discount means that this bond are issued at discount means that you have to pay only 9,500 of rupees. This is a discount you are giving. And why this discount? This is nothing but the amount you are getting as an interest of the coupon bond is initially discounted. That's why this is the case. And at the maturity you will get the par value. The par value means that 10,000 you have deposited, you will 10,000 whole sum at the time of maturity as specified. Next, the term is market value. When we discuss anything in the financial world, when we talk about the market, it simply means the sell and buy. The sell and buy of what? The sell and buy of the commodity, shares, derivatives, etc. So since bonds are also tradable in the market, are switched from one person to another. So lots of people are making profit by selling or buying these bonds. So I was talking about market, the market value. Since I said the market is all about buy and sell, and the price of that commodity always depends on the amount of buying or the amount of selling. If the buyers are high, then the price increases indiscriminately, and if the sellers are more, then the price decreases indiscriminately. That buyer and seller collectively, we will finding the market value or the market price, which is done automatically by some algorithms or programs are running at the back end, and these will calculated and shown in the screen. That is the market values. Next, the types of bonds. There are different types of the bonds. I will discuss everything because the directly questions, theoretical questions are asked from these things. So the first one is fixed rate bonds. As we have stated, the coupon rate is fixed in this fixed rate bonds. Next, the floating bonds. Floating bonds, the coupon rate got changed every now and then, depends on the market scenario. That is floating bonds. Next, the zero coupon bonds. The zero coupon bonds have the zero interest rate. And the zero interest rate in it, then you must have a questions then why people invest in that if the coupon rate is zero. The thing is that if the bond amount is rupees 10,000 of the zero coupon bond, then it will be issued at around 8,000 of rupees, and at the maturity you will get 10,000. So this difference you will get is nothing but your profit. So whatever amount of interest you will get in all these years, they will give you at the starting, they will discount you. This amount of money is nothing but a zero coupon bond. In India scenario, there are lots of zero coupon bonds are in the market or issued because it's a preferable one. Next, the high yield bonds. The high yield bonds are also called junk bonds. These are bonds which are issued by the very low rated companies which are not very good in their business. These are high yield bonds. Since the thing is that to any very low rated company, even the bank are discouraged to give loans, so they find it hard to raise the money from the public, so they give the high interest so that the people get encouraged to deposit the money. That's why the high yield bonds. Next, the convertible bonds. As I already discussed with you that there are two ways to raise money, the equity and the debt. And in the debt there is a bond. In the convertible bond, what it does, if the person wants after some period of time want to convert their bonds into equity or their debt into the ownership of the company, then they can convert it through these convertible bonds. Inflation indexed. These bonds are linked to the indexed to the inflation itself. Since we have read in the newspaper more often than not that the inflation's got high, the inflation got low. So when it's high, the inflation indexed bond. The inflation indexed bonds are indexed to the market inflation rate. Well, if the inflation goes high, the bond rates accordingly goes high and low according to the inflation. The other indexed bonds, there are also some indexes followed by our government of India, like the consumer price index, then Sensex, and all these indexed are very different, and it depends on the bonds to exist their linkage to this indexed. So these are included in the other indexed bonds. Next, the asset-backed securities. The asset-backed securities is that let's say you are depositing 10,000 rupees in bank B, and this bank B are saying that I am linking this amount of money with the some of his assets already existed, or they want to take this money to create some assets. So if something happened to the company or bank gone to bankrupt, then what will happen? then the company will sell this asset and it will give you the amount from this asset. So these are the asset backed securities. In this asset backed securities, the rate of interest are comparatively low because the risk is less. There is one very common phenomena in the bond scenario is that if the risk is high, the interest rates are high. If the risk are low, then the interest rates are low. That's why the government bonds are low interest rates. Next, the perpetual bonds. The perpetual bonds whose maturity period is never ending is perpetual bonds. Next, the bearer bonds. The bearer bonds, no name written on the paper if the bond are issued to the person. So it can be transferable or negotiable. They both are same thing. Next, the treasury bond. The treasury bond are nothing but the government bonds or the gilt bonds by the government where there is no provisions of any default. The next concept is callability and the putability. The optionality in the bonds. The topic name is optionality in the bonds and callability and putability. The callability and the putability is nothing but it's a share. If you read about the shares in the CAIIB, I have read. That's why I know there is very less chance that they will ask this callability or putability, but I know that's why I also want to give you some idea about this. Our callability and the putability. What is that? This is the power given to the person whether they want to buy or not. Let's say if the bond price is 10,000 of rupees, okay, and person A has this bond and he take the call option or callability option. How can person take the callability option? By paying some premium. It's nothing, just a insurance type of thing. So he take the callability option on this after 3 months. So after 3 months, if the price is 11,000, so he is getting profit of 1,000 here, so he will sell it. And what if the amount is only 9,000 rupees? So he is not getting profit here, so he will not sell it. He has the power to not sell it. That's why this callability option is exercised. Similarly, in the putability also, what it does, he buy in the putability, he has the power to sell. Let's say a person B took the putability option and person A. So if we take that putability option, so after 3 months, if the price is less than this, then only he will buy, because then only he will get profit if he sell to the other person at the 10,000 of rupees. That's the case in the putability. You just remember one thing, that the seller has the buyer has its say, but in the callability option, the seller has its say. So that's the when you see our course book, you will see two terms are very frequently used: PVIFA and PVIF. The PVIF full form is present value interest factor and the PVIFA is present value interest factor annuity. What is this? You will see this option, these terms in the numericals. These are nothing, just a table of all possibilities of years and all possibilities of interest rates. So it will give you just that at a particular time, let's say 3 years at particular interest 5%, how much you are going to get the values. That's the concept of this PVIFA. The examination conducted by the IIBF will never provide this table, so you have to calculate this manually. So there is no need of this PVIFA or PVIF. I would like to write one question. Kindly write it so that we could solve that questions and we will see how these bond questions are solved. The questions are quite same. You will find because there is not much concept in it. They will directly ask on these questions by putting some conditions or removing some conditions, but the basics are same. So write the questions. The par value is rupees 1000, bears a coupon rate of 12% and has a maturity period of 3 years. We will write the given things. Okay, I will complete the question first. The required rate of returns on the bond is 10%. What is the value of the bond? Okay, we have to find the value of the bond. The value of the bond is nothing but the present value. When they will ask about the value of the bond, it's nothing the present value of all the values you are getting in the consequent years is the value of the bond. So given things are par value. The par value is nothing but a face value in a zero coupon bond. So this par value, you can also write the face value is 1000 of rupees. Coupon rate is 12%. Maturity period is 3 years. So the required rate return of the bond is 10%. This 10% or required rate of return is 10%. I already state you the difference between this percent and this percent. This is for the bond, and this is the existing market rate, which decides by the market is the interest rate. So let's solve it. First we will see what is happening. You don't need to draw in the time of the examination, but I am explaining, that's why I am drawing. As in the first year, the amount was deposited 1000 of rupees. The person has taken the coupon, this bond of 1000 rupees. So he has taken 1000 rupees. In the first year, he will get the coupon of 12%. So first year, after the first year, he will get 120 of rupees. Second year, he will get 120 of rupees. Third year, he will get 120 of rupees. And since the maturity is there, so he will also get 1000 of rupees as the maturity value. So how much amount he gained? In the last chapter we have learned that whenever there is a year wise payment and you have to find the present value or the future value, you have to apply the annuity. Here the applications of what we have learned in the first chapter we will apply here. This is, since these are coming every year, so these are a part of annuity. But since this 1000 amount is coming at the last year only, applying the compound interest formula. So first we will see about by applying the formula of annuity, 120 into 1 plus this R here is 10%, 3 years minus 1, and since we are finding the present value, okay, 10 by 100. So we will get this, the present value of all the annuities through this formula. Now for this 1000 of rupees, as we know that in the compound interest the amount is equal to principal 1 plus R 100 into n. This is the compound interest formula. So what we are calculating, we are having the amount here because we are getting this as the final amount. So we will write in the place of amount. And what is the principal? This principal is nothing but a present value here in case of this. So 1 plus R is 10 by 100, and till it's in the for the 3 years we will write 3 year. So the present value is equal to 1000 by 1 plus 10 by 100 into 3. So when you will solve this to the by utilizing the calculator, as I already mentioned in the last chapter how to use the calculator, there is nothing new in that. If you will solve, you will get 1049.44. So here very good thing is that you are getting this amount is greater than what you have deposited. So this is a profitable bond. You should invest in this. Okay. So moving on next concept is YTM. YTM is nothing, but we will discuss through this example only. YTM is nothing. YTM is the rate at which if you apply that rate, you will get is all these amounts of the present value equal to this amount. Since here we are taking 10% of interest, and we are getting as 1049.44, so it's a profitable. So YTM is nothing, that rate. YTM is that rate which gives the present value of all these value equal to 1000. Another thing which is important here, what you are seeing, that coupon rate is greater than rate of return. So whenever the coupon rate is greater than rate of return, it's a profitable bond. You are getting profit, so we are telling profitable bond. There is no term like that. We are just mentioning that you are getting profit, that's why it's a profitable bond. So you should invest in that. And if the rate of return is greater than the coupon rate, then it's not profitable bond. You are in loss financially. And if it's equal, then the amount becomes equal. So these are the concept. The next concept is one theoretical thing. I would say that the lower the yield to maturity, the better the profit. The lower the yield to maturity, the better the profit. That's the one of the theoretical part of the conclusions of what we have learned. If you take an example of 2 YTM and you will solve the questions, you will see these conclusions as an evident. Next, the concept of premium and discount. Here in the example, we are getting 49.44 as an extra as compared to what we are deposited. So this is in premium. What if we are getting only 900 rupees? Then we are at discount as compared to the deposited value. Next, the concept is current yield. To finding the current yield, there is a formula, simple formula. The coupon rate value divided by the market value. Let's say the bond's original face value, any bond, the face value is 1000 rupees, but in the market the bond is trading at 800 of rupees. So we will write this 800 rupees here, and this bond coupon rate is 10%. So with the face value, this coupon rate we are finding, so it's 100 rupees. So if you multiply this gives some percentage. This is nothing but a current yield. At this time, this much interest you are earning. That's it tells about. And there's one very good thing. If the market, there's one theoretical questions can be framed like, if the market price goes high, then what is the impact on the yield? If it goes high, then the yield will be less. It's as simple as that, because it's a inverse proportional relationship. You are seeing there is inverse proportional relationship between them. And also in the market terms, you can understand like this. If the market price is getting higher, it means the demands are more. That's why it is going higher. And since the demand is more, the percentage interest will become less and less. I would like to write these conclusions, as these conclusions are directly asked in the examinations. The first one, the rate of return is equal to coupon rate. What will the value of the bond? It is equal to the face value or the par value. The next, if the rate of return is greater than the coupon rate, then the value you are getting will be less than the face value of the bond or the par value. Face of par, as par as zero coupon bond is concerned is same. The next, the rate of return is less than the coupon rate, then the value you are getting is more than the par value. If we take this example, the value you are getting 1049 is greater than the face value, par value 1000. So this is the 3 direct conclusions we wrote about this. I will also upload all the theoretical part what I have made, the notes about it. I will take the photos and will upload in the group, the Bankers Inside Out, in the Facebook. It will be available. You can take it if you need it, though I don't think there is a need. Practice as much questions as possible. That's the key to pass the accounting and finance for the bankers. You will easily get through. One more thing, one more concept is the bond price volatility. What does it mean? What is the bond price volatility? As I have said, the bonds are tradable in the market, and since it's a tradable in the market, so its price depends on the how much demand and the supply is, buyers or the sellers are there in the market for the bonds. So that this bond price volatility is only due to the demand and supply of the bonds. So that's it. Next I will upload the questions, important questions from these sections. Okay, that's it. Thank you.